Hello again, and welcome to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. My name is Randy Cook, and each week Jay and I sit down here and talk through some of the issues of retirement. If you don't have somebody helping you yet, and you've just been saving all these years and you wonder how this retirement thing is going to work, it's time actually to sit down with a financial advisor and map it all out and see what you're in store for, and if there's any problems along the way. And that's why we sit here and do this show. Jay, how are you doing today?
Good, Randy. How are you, bud?
I'm good. It's an interesting time of year, the holidays and moving into the new year. Everything seems to be moving around swimmingly. I've been out there amongst the crowds, and whether you're buying gifts or returning gifts or whatever you're doing at this time of the year, it's pretty crazy out there. But this is a time of year now that we got to start thinking about financial things. I mean, tax season's not too far away, and everybody wonders what's going to happen in 2026. So why don't we dive right in here? We have had a pretty good run here, Jay. 3 years in a row of double-digit returns in the stock market. That's pretty good. Are people feeling that? Are they feeling fortunate? Are they feeling like this is ho-hum, everyday kind of stuff? Or what are you seeing from your clients?
Let the good times roll.
Okay.
Right? The good times. Yeah. Now, in all seriousness, what you're bringing up is right, is that it's pretty unusual to have 3 back-to-back up years, right? Mm-hmm. Especially with double-digit returns. So now it's, well, can we go for 4? Are we going to, I don't know if you play craps, Randy.
I've done it before.
You play craps, right?
Not successfully,
craps. Yeah. Well, not most people, if they're being honest with themselves, have not played it successfully.
Right.
But when you play craps and you roll whatever, you're on the 6 and the 8, which is typically what I play, and you roll the 6 and you win, right? Mm-hmm. And you can do something called press a unit. Mm-hmm. Press a unit is, hey, like, take my winnings and just stack it back up on that number 6 or that number 8 or whatever it is. Mm-hmm. So we're going to press a unit this year? We're going to just let those good times roll in the markets? I don't know.
All right, let me give you a stat then, okay? How many times has the market been up 3 times in a row and double-digit returns? Over the last 100 years, 11 times. So it does happen. Right. How many times has the market been up just simply 4 years in a row? In the last 100 years, only 4 times. Okay, so the odds are against us. And I saw one survey, and they were asking people, 75% of investors in this particular survey said they're going to cut back on their risk, their equity positions next year. Mm-hmm. Is that something that people are talking about, saying, hey, Jay, I'm just a little uneasy. It's politics. It's the economy. It's all this stuff. Can we pull back a little bit on the risk? Is that part of the conversation?
Yeah, that's really always part of the conversation, because what we're talking about now is, we saw 3 years. Can we get 4? The biggest risk with investing always are the things that you don't even know are coming. Black swan events is what they're called. Just wasn't even on my radar. Mm-hmm. And this is the other thing. I have a sneaking suspicion that when we did the show this time last year, we were having a similar conversation.
I bet you're right.
We've had 2. Can we really go for 3? Should we pull back on that risk? Is it really worth it having out? And the problem we're always going to come back to with this, right, is what we're really talking about here is market timing. Mm-hmm. And we both know market timing is a fool's errand, right? Yeah. It just doesn't work. If the situation that we've had 3 up years in a row, trying to go for that 4, are we going to press that unit again, like I was talking about with craps before? We're going to just kind of like let these earnings roll and hope for the best. And that's your only strategy, and that's what's keeping you up at night, which it should be, frankly. If that's your only strategy, it should be keeping you up at night. Mm-hmm. You've got a much bigger problem than will the markets be up for a 4th year or not.
Mm-hmm. And that might be the red flag that we point out today on the show. If it makes you uncomfortable to be at the risk level that you are right now, because maybe you've been pushing in and pushing in and pushing in, and you go, should I keep doing that? That might be the red flag. Inside, in your gut, you're feeling, I'm too far out there on the risk level. Maybe I do cut back. Good conversation to have.
Absolutely. And what we're talking about is very different from rebalancing a portfolio because your allocations have got out of whack. We've talked on the show before about, if you've held NVIDIA and a handful of really high performers, well, your portfolio probably has just inherently more risk in it because now that represents more of your portfolio. What we're talking more about here with the markets being up and that keeping you awake at night, not knowing what to do, is far more of a high-level fundamental problem that you just don't have a plan put together.
Yeah, I saw an article about that, and they called it portfolio drift. They took a portfolio, and they said it was 60-40 in 2020, okay? 60% stocks, 40% bonds in the year 2020. They did nothing to it, okay? And in the year 2025, just looking at it, the equity positions had grown so much, it was now a 75-25% portfolio without you doing anything.
That's right.
So that's something that you can discover when you sit down and kind of do that analysis of somebody's portfolio.
Yeah. So we can look at that. And this is the other thing, and we've mentioned it before on the show. 3 years of back-to-back returns. There's been some bumps along the way, obviously. You know, what happened in April of 25, et cetera. Everybody tends to consider themselves an aggressive investor when everything's going really well. It's easy to think, I'm an aggressive investor. I've always been this way. I can take the risk. And then you hit that bump in the road like we did in April, right, of 25, and it's a bit of a reality check. And it's, wow, everything has been so good, I didn't realize there was this much risk in my portfolio. I didn't realize I was taking on this much risk and that I could be down, whatever it was, 12% in a matter of a handful of trading days. I didn't realize that. And it's also the fact that when you have that discussion with most advisors, when they're talking about risk, they talk in terms of percentages. And that's very different from what you experience in real life, because when you're dealing with your $1 million or $2 million portfolio and the conversation comes up, well, with the portfolio you've got, could we see a 30% drop if the markets were really bad? Well, we could see, 30%. Yeah, no worries. I can take that. That's easy. And that's also easy to say when you haven't had a 30% correction in quite some time. Well, that's 300,000 or 600,000, depending on the size of those portfolios we just mentioned. It is 30%. That's true. It's a little bit different when you say 600,000 on a $2 million portfolio.
Gets real. It really does. And then when you start talking about it in terms of dollars, and then you start talking about it in terms of trips and dreams and things that you want to do in retirement, and all of a sudden you can't do those things, that becomes a real issue. So the discussion about risk moving into a new year is certainly one that you're going to want to have, and maybe you want to have that right away. Sit down in January, because we're all going to be thinking about financial stuff, because it's going to be tax season, and all of a sudden you're gathering all your tax stuff, and now you're thinking about your money. Why don't you think about your retirement as well? Let's think about not just this 1 year that's ahead of us. Let's think about the next 10, 15, 20 years that's ahead of us as well. Give Jay a call. We'll go through the Get Me to Retirement 5-step process, and part of that, really, the first part is just listening to you, and then the next part, diving in there and finding out exactly what's going on within your money, and then making suggestions on how we can make it fit what your wishes are for retirement. Here's a number and here's a website. It's 210-985-6200. 210-985-6200, or use the website, which is retire210.com. Retire210.com. There's a place for you to put a little information in there at the bottom of the page, and the team will reach out to you at Secure Financial Management. All right, one of the things that we're finding that as people get toward retirement and they're like right on the edge, right on 1 or 2 years away, and then they start looking at their 401k an awful lot, and it's getting big. It's probably the biggest you've ever seen it in your whole life. And then you start to say, okay, I want to get into retirement. I want to be debt-free. I want all my money to go toward my fund and all my life expenses. So you look at that 401k and say, I'm going to pay off the house, or I'm going to pay off the car. It's really a very common thing. But Jay, dipping into the 401k to pay off your debts might make you feel good, but it might not be a really good financial move. Maybe you need to take that money from elsewhere. What do you say to people who say, I want to go into retirement debt-free?
Yeah, that's a lovely idea, but there's not going to be too many people retiring if you've got to be debt-free before you can retire. I can just tell you that, right? Like the people that we have come through, it happens, but it's pretty rare that someone is debt-free. And everyone ties being debt-free to retirement. being debt-free anytime would be good. It doesn't just have to be retirement, right? Like it's great to be debt-free, but unfortunately that's not the situation for most of us. And it's not uncommon that we get that person who, they've got $200,000 or $300,000 left on their mortgage, and man, if I could just get out from under this mortgage, I'd feel a lot more comfortable, or I'd be able to retire, or my cash flow would be a lot better. Can you do it? You can. But we have the discussion, hey, if you want to pay off that $300,000 mortgage, it's probably going to cost you $400,000, maybe more. Most of this 401k money, it's not Roth money. I wish it was. That would be fantastic. I'd love it if everyone's 401k was Roth money. But if there is a Roth component, it's usually quite small. I have a great story that I can tell you about this. I talk about this in some of the retirement planning seminars that we do. I had a lady, this is years ago, way before COVID. She came to an event. She was invited by a friend of hers who's an existing client of ours. She came and chatted with me for a little while after, and she's like, yeah, I need to come and see you. I was like, all right, well, whenever, just let me know, we'll get together. And she didn't come and see me. Well, she made several appointments and then canceled them. And it took her like 6 months to get in there. She came in and she said, well, I don't think you can really help me. And I said, well, I don't know what's going on with you. Maybe that's true, maybe it's not. And she said, well, I did something that was kind of dumb. I was like, all right, well, what was that? And so as the story unfolds, the reason she kept making appointments and canceling, she's embarrassed. She made a silly decision. And that decision was when she and her husband, when they retired, they wanted to have a beach house down here on the coast. Mm-hmm. She thought it would be a good idea to pay cash for that beach house. And guess where she had some cash sitting around?
The 401k.
That's exactly right.
All right.
And so it was like a $500,000 beach house, which 10 years ago, $500,000 could actually buy you something. So it was probably a nice house. So she had somewhere in the vicinity of $1 million in her 401k. So retired in October or November or something towards the end of the year. Didn't even do enough tax planning to say, if I'm going to do this, I'll wait until the next tax year. Did it the same year that all of her income and all of her husband's income was still being included, right, in their taxes. Pays cash for it. And so the 401k, typically what a 401k does, they will just withhold a standard 20%. You take out $1,000, you get 800, they send. Now, the 20% may be too much, or in some cases, such as this, it may not be enough, and may not be enough by a lot. So she spent the $500,000 and everything's great until April, right, when the taxes come due. And she's like, well, they withheld money from my 401k, and the CPA is like, yeah, that's not even close to enough. And so it's the $500,000 plus her husband's income and her income, and it's like it's like $800,000 or something is their taxable income as far as the IRS is concerned. Mm-hmm. So she owes taxes, and it's like a 6-figure tax bill. Well, guess where the money has to come from to pay that?
Not again. 401k?
Where's she going to get it? Right? So boom, back to the 401k again. Then fast forward to the next year, there still was not enough money withheld from the 401k. It wasn't as bad, obviously, right? But she still owed another 20, 30 grand in taxes. And so there's very little left in this 401k now.
Yeah.
And she said, I hate going to that house. Because when I go, this is what I'm thinking about, right? And to be honest, she was right. What am I going to do?
Yeah.
The damage has been done. Mm-hmm. And I know that's an extreme example, okay? But when you start having this discussion of 401ks, using them to pay off debt, it's not always a terrible idea. Maybe there's a credit card that you've got 5-10 grand on it. It's just hey, just make me sleep better at night to have this knocked out. All right, is that really a big deal? Probably not. When we're looking at trying to wipe out significant debt using a tool that is not designed for that, which is a 401k, there can be problems.
Yeah, when you dive into that 401k, that money gets added right on top of your income. And then the next year, Uncle Sam looks at you as having a whole lot more money than you actually did. And that is a decision you probably should run by somebody like Jay and say, okay, what are the pros and cons of this? And when you take out the yellow legal pad and all the cons look a lot worse than the pros, it's time to start to think about that decision real hard. Give Jay a call. This is the kind of resource that he can be to you. I mean, when we talk about having a financial advisor in your life and planning your retirement, that's not the end of the road. It is, this is something that you're going to need information, and you're going to need to lean on a resource like Jay probably for the next 10, 15, 20 years. So give him a call, give him a look on the website. Let's see if you work well with Jay and Jay works well with you, and see what your retirement looks like. We'll at least do that analysis for you and the Get Me to Retirement 5-step process. Here is the website, retire210.com. retire210.com. You'll see a place down at the bottom of the page there to put some information in, or just skip all that and give them a call. 210-985-6200. 210-985-6200. All right, so if you're traveling and you want to rent a car, the people at Hertz are doing something kind of interesting. You bring the car back after you've used it, and they run an AI scanner over the top of your car. They're doing this at 6 airports right now. They expect it's going to be 100 before long. What are they looking for? Oh, you were behind a truck and a rock came up. There's a little ding there that you can't even see, but the AI scanner can do that, and they charge you a couple $100 to fix that. The hidden dings of going out there. Oh, my gosh, I hate the idea. But, when we talk about financial stuff, the hidden dings in our financial plans, our retirement plans, sometimes, you pack money into a 401k and you don't even realize, this isn't the best thing in the world. Okay, maybe I should be putting my money elsewhere. What would you say if you somebody comes in with a portfolio, or even from another advisor, and they want you to look it over and give them a second opinion on something? What are the things you see that could be considered dings that we got to fix?
Yeah, it's going back to the AI scale. This is a true example of AI being used for evil. Like, is it going to be good or is it going to be evil? Well, this is an evil one, because I mean, how often is there a little nick or something that you don't even notice, right?
I know it.
They're always looking for more revenue, aren't they?
Yeah.
Yeah. I mean, we could spend a couple of shows probably on this, but I'll try and narrow it down to, what are the dings? So let me talk about when we create a plan and we've kind of presented it, here's the outcome, here's the next steps. There's a conversation I have with clients or people that are about to become clients when I'm talking about the plan, and I say, hey, look, there's a bunch of things we can do to make this work. Let's talk more about a couple of big things, 3 big things really, that would make this not work, right? Because that's the big thing, right? You're like, I want to succeed, but in retirement, I don't want to fail, right? That's the bigger deal. There's a couple of things, and I'll talk about kind of plans that I see come through that have issues as well. This is a plan that's looking out over, for a lot of our clients, 20, 30 years, multiple decades, right? There are going to be things that come up that we're not expecting right now. Like, it's just going to. The important thing is that we're staying on top of this. We're getting together on a set schedule, and we're staying on top of this to make sure that we're on course. If we need some corrections, we make some corrections. I mention investments. You don't have to get crazy aggressive for most people to make their retirement work. You also can't hide in CDs and savings accounts and money markets, right? And, 12, 18 months ago, when you were getting 5% on CDs and 5% on money markets, that made it a bit easier to do that, right? You can throw your $1 million in there and take $50,000 in interest a year. Well, rates have come down. They're probably going to continue to keep coming down, and just it's not practical to have your investments in that spot and expect it to last for retirement for most people, okay? The final one, and by far this is the biggest one. Wherever you get to in your, hey, I need X amount of dollars for retirement, and there is no average. People always say, oh, well, what does everybody else spend? I mean, it goes from 20 grand a month to 2 grand a month. Like it's all over the place, right? The important thing is we get the figure that you need to live the retirement that you want. And we have to stick pretty close to that. If you land on that $7,000 a month and the plan is very stable with that, if you keep coming back and saying, I had an emergency, I need 20 grand, and that emergency happens multiple times a year after year, well, there's probably a couple of issues there. It's not really an emergency, right? But then the plan's not going to work. right? It's just not. And more times than not that we have clients join us from another advisor because they're not doing their job, they're retiring, whatever it might be. They're coming to us and we do the planning because those are tough conversations to have. Like the easiest thing for any advisor to do is like, yeah, bring your money here, spend whatever you want, I don't care. Like there's no work involved in that. But having honest conversations about where people really are financially, that's the most important thing. And you come back and you hit your retirement portfolio for $5,000 here, $10,000 here. It is a tiny ding, right? It's like what we talked about, but you keep adding those dings up and you don't need an AI scanner to see them. You can just see them with your plain eye, right?
So is your portfolio too risky? Is your portfolio too conservative? Are there fees in there that you haven't seen? Are you headed for a tax problem? Are you headed for an estate problem? There's so many things. I mean, do you make too much money? Is your Medicare premium going to go up? Are you going to have taxes on your Social Security? I mean, there's so much here. And, all we've done all these years is pack money away. Just get ready for this time. And now we want to do it efficiently. To do that, there needs to be a plan. There needs to be a strategy for your money. Let's sit down and build that. The Get Me to Retirement 5-step process is what Jay will put you through at Secure Financial Management. And really what the first step is just a meeting and introducing yourself, finding out what you want to do for retirement. There's an awful lot of listening that takes place during that first meeting. Then let's get into what do you want to do? And is the money there? And do we have a problem? And then put it all under the microscope and figure it all out. That's the idea of starting out and having that retirement planning meeting. Here's how you do it. No charge, no obligation. 210-985-6200. 210-985-6200 or retire210.com. That's the website. Down at the bottom of the page, a place for you to put a little information in there, maybe a question, and the team will reach out to you. Again, retire210.com. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.